Next thing we have is competition policy. Now, competition policy is again it's a last area and the last way through which a government can influence in an economy. First thing is regulation and market failure. Firstly, you need to understand that why governments regulate and what is market failure. Market failure is said to occur when market mechanism of demand and supply fails to result in economic efficiency and therefore outcome is suboptimal. When companies and organizations starts to influence an economy in such a way that the demand and supply mechanism becomes weak or becomes suboptimal, it is at this point that government starts to intervene. Following are the cases where it is appropriate to regulate the markets. That first thing is imperfect competition. When companies start acting as a monopolist, they create an imperfect competition. The small organization cannot stand against large organizations, so their products will start to lose the market share because bigger companies, what they can do is reduce their prices to such a level because they have that thing called benefit from the scale of production, so they can reduce their prices substantially, whereas smaller businesses don't have that option. As a result, there's an imperfect competition in the market. At this point governments intervene and creates a legislation that no one can go with this price or increase prices above this price. They set a limit so that everyone have an equal chance in the market. Then we got social costs. Government again intervene when the social costs pertaining to the products being produced by the producers starts to affect the environment and the people. For example, cigarettes and cigar companies are mostly faces high taxes around the world because the social cost of those activities greatly it's quite high for the governments across the world to counter. For example, health problems associated with smoking and cigars create cancer and other sort of things, because of which the governments have to pay heavily to the in medical expenses for the nation, for the people of the nation, for the people of the country. Now, after that, we've got imperfect information. Most of the time, what producers involves companies and businesses do is that they create an imperfect information, such as they start funding those research that create a benefit impact for their company's products. For example, I'm a sugar manufacturer. I have a sugar manufacturing mill, and as a result, I will only fund those researches that shows that sugar is a very healthy thing. So that's how they create an imperfect information in the economy. Then we have an equity. Certain classes of people or certain segment of a people, perhaps few rich category of people, few families starts dominating an industry. For example, shoes and leather industries being you can say operated by only a single family in a single country. So what government in these circumstances do is they create a price fixation. What they remove the barriers in the entry by allowing the import of leather goods as well, so that they can create an equality among in the market. After that, we got types of regulation. There are different types of regulations. Regulations can be defined as any form of state interference with the operation of the free market. In many markets, the volunteers may decide a system of voluntary self-regulation to avoid imposition of government control. Now, there is a direct regulation called the letter of the law, and there is a self-regulation. The accountancy framework used to monitor across the world is a self-regulation based, it's a principle-based approach. Non-following will not lead you to jail, however, it will create a bad impact and bad publicity for the company. Where the strict regulation, as we all know, is a government imposition. This should be done and this should be not, otherwise you'll face penalties. Then we got monopolies and mergers. Monopolies basically involves one producer is dominating an entire market, because of which people have limited choices, and who also does not let other small businesses or anyone enter the market. For example, uh, the most famous brands Coca-Cola and Pepsi basically dominates every country across the world. They keep their prices at a nominal level despite the currency differences across the world. They keep their prices at a nominal level. This creates this deters the newcomers into the market. However, governments across the world uh, do the best which they can to create an equality among the markets. Now, there are, however, certain advantages of monopoly as well. For example, economies of scale. The certain things can only be made available to a local people in cheap cost if they are made in on large scale, such as in steel industry. Steel products will only be cheap if they are made on large scales. Then we have got maximize profits. Obviously, those industries that operate on large scales will always have large revenues as well. Then we've got disadvantages. Who is to stop them from setting higher prices? Again, no one. They are the monopolists. They have no threat of competitor around them, so they can set higher prices for their product. No incentive to improve their product or offer a wide range of products. There is no incentive, because of no competition. They do not need to keep the public happy, as people will have no choice. They have no substitute to go against those products being offered by the monopolist. Then we've got no pressure to improve efficiency and use of resources. They don't have to worry about the cost or anything. Their profits are high. They can waste as much as they can. There's nothing on the. There's no effect on their profits. Then we have got oligopoly. It's somewhat similar to monopoly, but in a different way. Here, two or more producers collide, they fix their prices, and combinedly act as monopolists. They set their prices. For example, two beverage companies will collide with each other. They set their prices at a certain level that we will not compete with each other from now on. However, we combinedly will control the entire market and will not let anyone else enter to the market using our combined size. So, in all these circumstances of monopoly and oligopoly, we have authorities must decide whether the monopoly is acting against the public interest or not. First thing is they look for is that if they're acting against the public interest, they have certain counter measures as well. They can do is price cuts. The first and most powerful weapon the government has is they can put a regulation of price cut. You cannot sell this product above this price. Then we got price and profit control. Your profit should be in this range, otherwise that is the profit per product should be in this range, otherwise you have to show the cost. Then we have got removal of entry barriers. Government can do is start giving tax incentives, start giving easy borrowings to the people entering the industry. They will focus on industry specific grants. Then we got breaking of the firm. As a last resort, what governments do is instead of having a one big monopolist, they will break it into 5 companies, or there will be a parent and there will be 4 subsidiaries of, but still they will be separate companies. So they have some level of exposure to the regulation and some lose of control over the market share. As far as oligopoly is concerned, authorities must watch for any mergers or acquisition that may result in monopoly. Then we got restrictive practices. It involves legislation that will restrict practices that distort, restrict, or prevent competition. Example: price fixing, predator fixing, and refusal of supplies to competitors. Supply, you can say the big companies does not necessarily have to have a monopoly to gain a market share. What they can do is have such arrangements with the suppliers so that their suppliers do not supply to their competitors. They can do that because of the size of their own size. They have an influence over the suppliers. Governments have restrictive laws to prevent this from happening. Government can do restrictive practices. Then we got deregulation. It involves completely removing or weakening of barriers on free market activities to authorities to allow free markets to focus to determine the outcome. There are certain benefits to that of deregulation. Improve incentive for internal cost efficiency. That's the disadvantage of monopoly, and here is an advantage because they are now not a government company but a private company, so they have an incentive to move towards cost cutting. Then we got improve allocative efficiency. They can allocate the resources much more effectively. Then we got disadvantages, laws of economies of scale. Now, uh, as I've just told you that certain products can only be made available to the people if they are that is cheap, if they can be made available to the people cheap if they are made at on large scale. When it comes to deregulation of public companies, this effect is lost because now there are smaller companies producing the same thing. So this creates an elimination for the economies of scale. As a result, the cost of those products starts to increase. Then we got lower quality of content services, as there was one unit to producing the same thing again and again, and a few number of people dedicated to do that. Now individual firms and companies have to hire their own people and establish their own processes. Obviously, the quality of being produced by one company, the goods being produced by one company will always differ from the other. Then we got need to protect competition. Even if they are deregulated, the competition or the free market mechanism should need to be protected. Then we got the privatization, one of the forms of deregulations. Here what we do is there are basically three broad terms for privatization: the deregulation of industries, which I've just explained to you. The company can go from being government owned to private owned. Private owned also involved that the shares can be circulated in the stock exchange, so they can be public owned as well. Then we are contracting out work to private firms. One way of deregulation is instead of giving contracts to the government firms, government gives the contracts to the private firms on equal terms, irrespective whether it's a government organization or non-government organization. They see whose proposal is the best and give the contracts to them. Then we got transferring of ownership of assets from state to private shareholders. As I just told you, they can go public and transfer the state assets to private. Now, it can improve efficiency by increasing competition. As now these organizations being owned by the private sector, and this is a further addition to the already existing competition in the market. So this increases the competition, which forces the organizations to create innovative, cost-effective products for the people, for the consumers. Then we have got industries more cost conscious. Now they are private sector, though they have to be following the principle of cost minimization and profit maximization. Simple as that. Then we have got advantages. First advantage is they provide the immediate source of finance. The government can sell an industry and get the immediate source of funds which the government needs to run the country, or if they have other plans. Then we got reduced bureaucratic and political meddling. No hiring firing is done on the basis of political grounds now in the organization because it is now privately owned. Then we have got encourages wider share ownership. Because of the wider share ownership, no single person can control the entity, and as a result, there is more accountability towards the people. Then we got disadvantages. State-owned industry is more likely to respond to public interest than profits, as now they are private sector organizations, so they will be mostly, for the major part of their focus will be on profits rather than public benefit. Then we have got inadvisable, where significant economies of scale can only be achieved via monopoly operations. Deregulation is, or deregulation is, you can say, highly inadvisable to scenarios where economies of scale is the only way to benefit the consumers. Then we've got privatized businesses act as monopolists or oligopolists. Eventually, as the time passes by, eventually they will start to act like a monopolist or perhaps oligopolist. Then we have got government assistance to businesses. Now, government assistance is given to businesses in two areas: regional basis and selective national basis. Regional basis involves government wants companies to be established or industries to be established in a depressed area of their country. So for that specific area, grants will be available, such as tax incentives for a couple of years, tax incentives on purchase of machinery, and you can say government support in obtaining the loan, that's sovereign guarantees. Then we have got selective national basis. In this area, the government wants specific industry sector to progress, such as the textile industry in any country. If the government wants that to progress, they have to give them incentive, give them electricity at reduced rates, reduced taxation on their imports, so that they can import more material and produce more goods. So these are the things which the governments do in the form of assistance that is being provided to businesses. Then we have got externalities. Now, externalities this word implies the effect of business activities on the environment and surroundings. So externalities, whether positive or negative, resulting from production and consumption activities, affect the third parties. It involves levying taxes on polluters and provides subsidies to new machinery and equipment. Oil industries always face heavy taxes across the world because their product produce pollutions. The extra tax being obtained from this industry is used in the hospital sectors to counter those effects, such as heart surgeries and lung diseases. So that's the effect of externalities, and it's a simple, straightforward strategy which the governments use. Then we've got legislation. Imposing legislation on pollutants such as waste may only be disposed of with prior consent. If exceeds limit, the polluter is fined. Certain level of pollution is allowed. After that, the government starts to fine that industry or that you can say factory. After that, we've got an advantages of environment friendly policies on businesses. Environmentally friendly customers are more inclined to buy its product. People are getting smarter. They don't just buy things from the rack on a shelf of a supermarket. Nowadays they turn it and see what's in it and which company is manufacturing it, and this is the reason now people are buying those products that specifically claims that they have not done animal testing or the products do not harm the environment. Then we've got enhanced relationship with the public in general. because the business cares for the environment and the people will start to give respect to the businesses and its products. Then we got people may prefer to work with environment friendly businesses. Nowadays it's one of the things that's trending very fast. People work with the environment friendly businesses. If the businesses claim that they are environmentally friendly, only then they apply there. And if they are not very much environmentally friendly, then they tend to find one that's environmentally friendly. Then we got ethical investment funds. Nowadays there is a fund named ethical investment funds that again very useful. If we have got a green tag, if our business got a green tag, we can utilize this fund as a source of finance for our business, because it will be easy for the company to raise fund in the stock market or in the financial market because of these sorts of funds. If we have a green, but however these are only accessible if we have got a green tag with the on the business. After that, we have got the last topic of this chapter, that's corporate governance regulation. There is a significant impact of corporate governance requirements on businesses. Businesses that fail to comply with the law runs the risk of financial penalties and bad publicity. However, I would say the bad publicity part is more concern, needs to be concerned, because things can go really out of hand really fast in the today's social media frame. So, however, consequences of not complying impact share price. If the businesses do not comply with the corporate governance regulations of ethics, they will face bad publicity. However, if they will comply, they have to bear the cost as well, because as with everything, following of law, obedience of law always have an extra cost. That's it for chapter number 2, the economic environment of the business. Thanks for watching.